Well, good morning, everybody. Welcome to the November 18th meeting of the Town of Merrimack Board of Trustees of Trust Funds. I'm Chris Christensen, Chairman of the committee, and to my right is,
Bill Wilkes, trustee.
and my immediate left,
Pat Heinrich, trustee.
further left,
Tom Boland, Town Finance Director.
and we have three guests today, if you'd like to introduce yourselves.
Judy Noel, Cambridge Trust Company.
Lindsay Donovan, Cambridge Trust Company.
Eric Jusome, Cambridge Trust Company.
Very good. Thank you all for being here. So first order of business is the minutes of October 21st. Do we have a motion?
Okay, I'll move.
I'll second.
Any discussion? All in favor signify by saying aye.
Aye.
300. Next item on the agenda is a portfolio review with Cambridge Trust. I don't know who's going to speak first, but
I'll
jump
kick
right
it
at
off.
it.
I'll kick it off. Just move ahead one slide here. I'm just going to do more of an executive summary talking about what's been going on in the markets. Obviously, there's been a lot of volatility this year. At Lord's point, the S&P was down over 25%. As of yesterday, it's down about 17%. So the market rallied about 8% in October. But we feel the market still has some headwinds facing it. The Fed continues to raise interest rates. We've raised rates over close to 400 basis points so far this year. But there's been more and more conviction or talk in the market that the 75 basis points, we've had 4 meetings of consecutive 75 basis point increases, that those increases may start to slow. It looks like peak inflation may be starting to roll over. Latest PPI and CPI have shown inflation starting to moderate. But there's also, it's going to, the Fed moving to 4%. If you look at the Fed futures, there's a chart in the appendix looking maybe at 5% for the peak. Again, that's based on current. As more data comes in, those figures will change. But the market's expecting this Fed pivot, that they'll be, becoming less restrictive moving forward. So if we're at, 3 3/4 to 4%, if the target is 5, you can see that we're getting near the end of this interest rate cycle. But it's going to, all will depend on how quickly inflation abates. And as we're now nearshoring and bringing, everything back onshore, that can be inflationary as well. So it's hard to see how the Fed's going to get to their 2 to 3% target when we're currently at 7 to 8%, over 7%, close to 8%. Policy increases, interest rate increases do have a lagged effect. So that's what we're, the market's waiting to see. When do these start catching up? And you're starting to see it, mortgage rates have moved higher. You're starting to see inflation is starting to moderate, but consumer continues to spend. So consumer spending continues to be very robust. Retail sales come in much higher than anticipated. Talking about interest rates. So, interest rates are the highest they've been in 10 years. We've seen a substantial increase in rates. At the same time, we have an inverted yield curve. So historically, an inverted yield curve has typically been associated with an economic slowdown 6 to 12 months after the inversion. So the inversion happened last spring. So, there could be at some point in 2023 where we may have some sort of an economic slowdown. We've already had 2 consecutive quarters. So Q1, Q2 of this year were negative GDP. Third quarter was strong, and fourth quarter, based on the Fed Atlanta now, looks like it's going to be about 2.6%. So if the Fed continues to, if the Fed's raising rates and high inflation, you're starting to see growth increase, the Fed may have to be more aggressive. And at the same time, they're unwinding their balance sheet via just, roll off of the interest and principal of the portfolio. They can steepen the yield curve if they were to actually start selling more securities out in the secondary market. So the Fed does have that $7 billion balance sheet at its disposal of which to unwind going forward if they need to. Unemployment continues to be strong, although you're starting to see from the tech sector some layoffs starting to happen. Unemployment rate was 3.7%. Job growth, we created 261,000 jobs in October. So the Fed still has a lot of work to do, but again, there is the policy lag as the Fed has aggressively raised rates this year. With that, I'm going to turn it to the next page just to talk about, the overall yields of the portfolio continue to increase. Per the investment policy, targeting a 2.5% to 4%. You can see we're very close to 4%, especially on the common funds, principal and income, about 3.78% on overall yield. Scholarship is a little bit behind that, as that's invested more in a bond mutual fund, and that will catch up as the policy lags and as those reinvestments happen in the fund, those yields should increase as well. Just to highlight the equity yields, on this, well over 3%, close to 3.5, 3.7%. So, when we talk about the performance of the portfolio very shortly, so the common principal income and scholarship equity portion of the portfolios have really outperformed the markets by at the end of October they were down 3.5%. Market was down over 17%. So really strong outperformance. Not as much turnover as in years past. We haven't had much turnover. Focusing on the discipline of dividend paying stocks in the portfolio. We've made some changes on the common and income funds within the bonds in the portfolio. We have sold some of the lower coupon bonds and repositioned higher coupon bonds. Recent trade, we sold Honeywell's maturing in 26, rolled them out to the new issue Honeywell's of 28. Coupon went from just under 3 to just under 5. So, 200, almost a 250 basis point increase in income. And we continued with, what agencies were sold in June and repositioned, selling 1% and 2% coupons to pick up 4% or 5% coupons. So the goal is, as interest rates are near or at their 10-year highs, is to continue to build out higher coupons and higher yields into the bond portfolio.
So do you take a loss on those when you sell? the
We did,
lower-
yes. Yeah. It's same thing as selling a stock at a loss.
Right, so,
The payback periods were under a year and a half, with the higher income taking the loss. So we figured that was, considering it's a longer, it's a 6-year bond, you're recouping that loss very quickly with the higher income.
So before we go on to the next stuff, any other questions?
well, on the bonds themselves, I mean, like, back in the common funds or whatever,
Mhm.
what's the mix of the bonds in there? Like, a certain amount treasuries, certain amount
There's,
corporates, or?
yeah, it's about 50% corporates and 50% a mix of agencies and treasuries. And the corporates are all investment grade. There's no high yield exposure or below BBB exposure in the individual bonds within the portfolio. So it's high credit quality. Honeywell's a single A rated credit. So I think, there's credit quality at the same time, taking an opportunity to really build out the long-term income of the portfolio. We did buy a 10-year treasury as part of a swap that we did earlier. So there are some longer bonds in the portfolio, but overall the durations are right at the benchmark, about 4 years for the common funds.
So as interest rates go up and earnings flatten
Mhm.
at best, with a equity dividend focus, I don't see, and maybe this is wrong, I don't see increased dividends in the next several quarters, probably 2 years. I'm wondering what you think of that, and if we should be looking at a different perspective on our dividends. I don't necessarily want to change that plan, but I'm just curious what your focus is.
We believe the dividends in the portfolio for the stocks, those dividends we're not looking at the dividends being cut based on our analysis. Rio Tinto has about a 10% dividend yield. That is, safe and secure going forward, as a very low payout ratio. So we feel, the companies that are in the equity sleeve of those portfolios, the dividend yields are sustainable going forward. Obviously, if the market rallies just by, appreciation, the yields would come down. But we think overall those yields are sustainable. We don't expect any companies to be cutting their dividends at the moment. If there's a full blown out deep recession that we're not forecasting, then that may change. But based on, a soft to a bumpy landing, there's a chart in here that looks at, earnings for Q3 were actually surprisingly better than feared. Our biggest concern is earnings estimates for 2023 really have not come down yet. What multiple do you apply to? We think it should be closer to 220 versus 230, which is consensus. So we think going forward, there could be some earnings pressure, or there could be a little more of a headwind facing the markets. But we think the long term still looks very promising, for equity returns as well as bond returns, for the simple fact 10-year highs in bond yields. At the same time, you're back to trading about your 10-year average for a forward PE multiple. So the market isn't overly expensive. And so we think over the next 10 years, you probably revert back to what is a normalized, annualized type of return for stocks of 4 to 6%, and bonds actually higher than we've been for the last 10 years, probably closer to 3 to 4%, just because the yields are so much higher and you have that total return opportunity, for capital appreciation. As interest rates decline, the bonds value would increase as well. But that's why we look to increase longer term, going out a little bit further on the curve, 5, 6, 7, and 10 years, to take advantage of those higher yields that are available for the common funds. And we'll continue to do that as we move through the next couple quarters. There's some maturities that are coming up on the common funds. We'll look to reinvest those.
So do you, if I'm understanding you, bond returns ahead of benchmarks due to overweight corporate bonds and underweight duration. Are you recommending that we increase duration, or that you increase duration?
We
Or
probably would move. We wouldn't necessarily go over the benchmark duration, which is about 4 years. Give or take a little bit. We're not advocating right now to go to a 5 or 6 or 7 year duration. We think we typically run all of our portfolios neutral to the benchmark as close as we can. And not
status quo is what you're suggesting?
status quo, correct?
Thank you.
Yeah.
Okay.
I'm seeing a little bit of slowing in real estate. We don't do a lot of that directly, but obviously it impacts the overall economy. Houses are staying, or real estate in general, whether it's housing or commercial, is staying on the market longer. Prices aren't holding up, or aren't extravagant the way they were 2 or 3 quarters ago. Do you see anything there that's going to affect overall market or our portfolio?
The portfolio has no direct exposure, to the housing market. So it would be more of the impact to the overall economy if housing weakens further. But I also look at the demographics that are in place right now, where the population growth has outpaced the growth in homes. So there's a shortage of homes in the market that may act as sort of a stabilizer. So the prices will come down as interest rates have increased, and we've already seen that. So there will be a natural equilibrium that will develop. So homes are still selling. They're not selling, pre hitting the market, and their bidding wars have slowed down. But home prices have come down maybe 5. It's hard to say here in the Northeast, but in other parts of the country, home prices have come down a little bit more than here in the Northeast. We think overall, if you look at what caused the real economic pain back in the great financial crisis of 2008, 2009, that was led by basically poor capital underwriting standards by the bank. So it was a big capital issue. Capital ratios are very, very weak. This time around, the banks are extremely solvent. We're underweight banks, more exposure to regionals. But JP Morgan and Bank of America all had really strong third quarter earnings, really strong net interest margin ratios. So overall, the banking sector is much more secure than where it was back in the great financial crisis.
Thank you.
Yep.
Anybody else before we move on? Let's move on.
All right, just quickly, the municipal water school portfolios are all benchmarked, 1 to 3 year maturities laddered out. Durations are approximately 1 year. So as bonds mature, we're rolling those out into the market to get higher yields.
We're on a different page on the screen.
I'm on
Still last
still
bullet.
right
The
there,
last
bullet.
last bullet.
Oh, I'm sorry. Okay.
Yeah. Just quickly going through some appendix charts here, if you want me to, or we can go to a Q&A or talk about anything on the agenda. There's a couple of slides here. Kind of talked about it earlier, looking at S&P forward valuations over the last 10 years. So we're trading, we're not overly expensive, not overly cheap. You're kind of trading, look at that bottom chart there, you're kind of trading at the 10-year average. So far, if you look, as I was mentioning earlier, for Q3, better sales. Earnings were a little bit weak, and this kind of shows you where some of the earnings misses happened, coming a little bit from discretionary. Staples, discretionary continues to do well. Healthcare had a little bit of a pullback. Industrials, some of more of these economically, cyclically sensitive sectors having a little bit more of earnings growth declines in the third quarter. But overall, if you look at the top, the S&P, the earnings, if you look at the sales growth, was expected to be 9.7%. It came in at 9.9 on the market as a whole. Earnings growth 4.5 4.5%, they came in at 3.1. So hitting on the top line, missing a little bit on the bottom line. And this just shows you by the individual sectors, where the sales surprises, earnings surprises, sales growth and earnings growth, where, some of the vulnerabilities were. Healthcare had a little bit of a pullback, but again, healthcare has been one of the more positive return sectors this year, especially some of the stocks in your portfolio outperforming the market. Energy continues to do really well. Again, we're overweight energy in the portfolio. Utilities probably getting a little expensive here. Another area where, getting those very attractive dividend yields that we have a little bit of an overweight to as well. But overall, it's not catastrophic just yet. As I mentioned earlier, we're more focused on earnings guidance going into 2023 and how much that may come down to reflect current market conditions. This is a chart that I was referencing earlier. So this looks at, this is the Fed futures implied forward curve. So it gives an idea of what the market's anticipating for future Fed rate hikes. So at the December meeting, you just look over in this column I have my cursor on, if you can see it. It says implied rate. So that's the expectation that the Fed will move 50 basis points at their December 14th meeting. There's no meeting in January, but when we move out into February, probably looking at another 100 basis point. You can see the implied rate capping out at about 5-ish%. And interesting, if you look going into 2024, the market's already pricing in the Fed will have to start cutting interest rates.
Let
Again,
me back you up just for a second.
yeah, sure.
100 basis points when?
100 basis points total between December and February. So
Thank you.
50 at each meeting.
50 and 50. Okay, that's more what I was
Yeah.
calibrated to.
So overall, it's hard to believe that the Fed is going to raise rates into the first quarter of next year and then cut rates the first quarter of next year. I think that's where the market's anticipating this pivot that they're going to maybe slow that 50 to a 25 in February and then kind of be done, be more data dependent moving forward. Several Fed speakers have come out and said 5 to 5.25 is the target they're looking at. But again, that's just one governor. It's a consensus vote that moves Fed funds rates. Wanted to put this out there. There was a question that was asked in the meeting, in the minutes to us about the income. Judo, if you want to talk for this.
Well, this information was pulled directly from the annual MS9 reports, and it breaks down the income that was reported by each account for that period, ending June 30th of each year.
Good progress.
Very good progress.
Okay, so
And there was a question on the JEPI fund that we have. So it's a option writing fund that's based on the underlying assets of the S&P 500. We chose that because it's more diversified, so it's not heavily invested into tech, so it's sort of a market weighting in tech, so it has a little bit lower of a beta, and it's generating a current yield right now about 10%, which we think is for paying out income. It's a small portion of the portfolio. It's about a 2% weight, but we think overall it's a sort of acts as an equity surrogate, with about a 65 basis point beta, so much less volatility than the market as a whole, while generating more current income of about, close to 10%.
Can you contrast this one with the JEPQ?
Sure, JEPQ is off the NASDAQ, which is more tech focused, so has more volatility to it. So this is more diversified. So it doesn't have all that tech exposure, and it has a longer track record. JEPI has less than a 1-year track record. So we chose something that had prior history to relate to.
I was just a little bit surprised to see it pop up, but I like the diversity.
So just a few examples of what's in that portfolio?
Sure. So it's a portfolio of high quality, low earnings volatility stocks. So it's a more defensive portfolio. So it has a limit on sector weight. So it's an underlying basket of the S&P 500. So you consider almost like the replica of the S&P 500 index as the underlying holdings. And then there's call options on the S&P index that are written against it.
This is totally different question, but
Yeah.
everybody loves to use that buzzword tech.
Mm-hmm.
And to me, just listening to a lot of talking heads, tech to them means Facebook, Netflix, Amazon.
Which aren't tech companies.
which,
Are but aren't. They're not
Yeah.
classified in
I
the
mean,
tech
but then
sector.
you have Cisco coming out, what was it, yesterday or the day before, and pretty positive very positive results and positive outlook. I mean, they're a hardware company.
Yeah.
They do some software, but they're a hardware company.
Mhm.
So they're gonna consume semiconductors.
Yeah.
Automobiles are coming back. They're gonna consume semiconductors. There's other industries that do the same. So how do you differentiate that, and how, from a standpoint of, and what are your thoughts about that? I mean,
So
the
there's
people
this.
who are more traditional tech,
Mhm.
in my mind, traditional tech is hardware and software.
Yeah.
It's not Amazon, who has some little cloud services or whatever,
Yep.
that
So-
sort of thing.
No, that's a great question. So obviously there's this mega cap tech, right, that has dramatically underperformed the market this year. Those were the darlings of 2019, 20, and 2021. We do not have exposure to those mega tech stocks in your portfolio. We're mostly into the semis with Texas Instruments and Broadcom. Reason being, we had Apple in the portfolio, but Apple has a very, very low dividend yield. So in order to achieve the dividend yield of the portfolio, we chose Texas Instruments, which actually has a really good return this year, as well as Broadcom. So so we're very underweight tech, and we've used some of that tech underweight to go overweight like communication services. So AT&T, strong, probably not going to grow as much as some of those tech companies, but a very stable 5% grower with a 7% dividend yield. Overweight energy, Chevron, Exxon, as well as Pioneer Natural Resources. Overweight utilities, Atmos Energy and Wisconsin Electric outperforming utility sector as a whole, and a little bit more exposure to REIT. So we added more to the more dividend sectors that we're finding value to in lieu of tech, because a lot of tech just doesn't pay a high enough dividend yield above the S&P 500.
So you mentioned REITs.
Yeah.
And we talked a little bit about housing and that's that issue. And basically, I think the softness, if you want to call it that, in housing is because of the rates. There's an inverse relationship to what people can afford. We all know
Correct,
that. And so there's a lot of people speaking about shortage of apartments, and they're building them like crazy right here in southern New Hampshire.
Mhm.
And I'm saying, who's going to fill all these things? But if you look at it from a macro standpoint, I guess the numbers support that more apartment complexes, and if people can't afford a mortgage, they have to live in an apartment. So, what's your position on REITs, and are there any particular REITs that you're looking at?
We have exposure to American Tower. So we don't have any real exposure to housing in general. So it's mostly on American Tower as well as Prologis. So that's our main exposure in the REIT sector. So no exposure to shopping malls or those brick and mortar type businesses.
I
Looking
heard
more
that
towards
Prologis,
digital warehousing, things like that.
I heard that Prologis has a 2% vacancy rate right now, even because they have long-term leases signed.
Yeah. Mhm.
So even if the space is not fully utilized,
They're still paying
they're bound by the leases.
Yeah.
And they're big companies that are bound by the leases, so it's pretty safe,
Yeah, that's why we own it in the portfolio.
Yeah.
We've owned it for several years.
right?
Anybody else? Moving on.
I'll have Lindsay talk about, where current yields are, where we're typically investing for the capital reserve portfolios.
We're always interested in the latter.
Absolutely. So rates have moved up significantly this year because of the Federal Reserve increase in rates that Eric was talking about earlier. So we are seeing some attractive rates going out, basically through the 5-year ladder. It does make sense to have some diversification here, looking between treasuries, CDs, and agencies. Different parts of the curve are showing different levels at this point. We do have, specific allocations that we have to do within each of these portfolios. So not each of them can go out to the 5-year and get something like that 5 or 6% yield that we're currently seeing in CDs and agencies. But even going out to 2 years, so a 2-year CD, this is from last week, so things have, repriced and might not be available at the exact same level, but we are seeing similar levels this week. But a 2-year CD currently yielding 4.9%, or if you're able to go into a government agency and go out and see, 5.4% rounding. So compared to last year or the year before, where we were seeing, 10, 20, 30 basis points for going out 2 years, significant improvement here in terms of rates. We do see an inversion, so similar to the overall treasury curve. You going out further into the future, you actually get less yield within the treasury curve. We see flatness within the CD curve, so going out past 2 years at 490, going out to 3 years, you're only getting 495. And we're seeing similar rates in the 4-year and the 5-year at this point. So for going out that additional duration, you're not picking up that much extra yield, because it really is based off of the flatness and the inversion of the treasury curve. Agencies, you do get a little bit more yield going out further, but they also have a different structure where you can have callable agencies. So they could be called away from you before the final maturity happens.
The real rate of return, though, really is less than what you were getting, even when you were getting like very few basis points because inflation wasn't as high, right? So if you look at the real rate of return, we're kind of treading water at best. And I guess the trick in my mind is, how much of a commitment you make out into the future with rates versus how quick the Fed can bring inflation down. Because if you can lock in some rates that are good, and hopefully, we don't have crystal balls, but hopefully inflation goes down, then you're going to make a higher real rate of return, correct?
Correct,
Right.
yeah.
Yes.
Except that on capital reserve funds, while it's nice to get better returns, the basic goal and why we're restricted is protection of capital.
Correct, but I
Protection
mean, if you can get U.S. Treasuries, there's no,
There's no
we're not being reckless there.
No, everything is
Right.
between the treasuries, the CDs, and the agencies. There's all either government or FDIC insurance. So there's no credit risk involved.
I mean, everybody's got a different perspective on what will happen. It's kind of like, I don't want to say it on TV, but it's like rolling the dice to some extent.
Well, you're on TV now.
Yeah, and I think that's why we've tried to, in the common funds, go out just a little further because, if the Fed is able to get inflation under control, that's probably going to come with some sort of pain via economic slowdown, which would cause longer rates to come down. So we wanted to lock in, the 10-year. You're never going to time the top of a market or the bottom, but yields at 10-year highs to us seemed like a really good opportunity. Last year going out and buying a 5-year bond, you're barely getting 1.25%. As this shows you here, in corporate, you're getting 6%. Very close to 6% depending upon the issue. So to us, it seemed like a really good time to lock in some longer term money, especially in the common fund where we have that ability to do so.
Lindsay, moving on.
Great. Okay. So on page 12, we have the Merrimack Capital Reserve water account. Currently split between cash and fixed income products, so following mandate there. Going on to page, I think this is 13. My numbers are a little bit,
14.
is it 14? Okay.
Yeah, right on.
It's whatever it is, it's the next.
Okay, so on a total return basis, looking at performance year to date, down 1.07%, because of the mark to market that we see within those markets. So cash, positive 49 basis points. We have seen an increase in our money market rates over the year to date period. Fixed income, we're seeing that negative return. What that really means from the management standpoint here, if we were to go out and sell those bonds in the market today to try and raise cash, we would get less than par, so less than $100 back. We are, as you mentioned, looking at capital reserve for this, so we would hold them to maturity, at which point you would get par back. it's really looking at the opportunity cost there if we were able to go out and redeploy it at today's current rates, for that difference that we're seeing there. Page 15 is looking at the benchmarks that we have for this portfolio. Moving on to the municipal account, so $5.7 million, split between fixed income and enhanced cash there as well. Page 16.
Hang on just one
Yes.
second. Tom, you got a figure yet? I know it's premature, but how much money we're gonna get in December and how much we'll want back in June, or is it basically the standard 2 million in each direction?
It's gonna be, it should be a little over 2 million that's going in December. And I expect it'll be similar to what it's been in the past of what's coming out in June.
Great.
So there's our opportunity to do some 6-month stuff,
Absolutely.
or 3-month. Thank you.
So going on to page 16, very similar in terms of performance here, negative 2.26% on that year-to-date period, positive 90 basis points in cash, down 3.46% from the fixed income side. This portfolio does have a longer maturity ladder in place, and longer rates are down a little bit more compared to shorter term rates here in this period. Skipping to page 18, 19. Looking at the principal fund. Do you want to go over the principal fund or?
Just quickly, you can see the asset allocation on the left side, top left. Equities are about 65%, bonds and cash making up the difference of about 32-33%. Just to highlight the performance year to date, down 5.23% in total. The growth, like a growth taxable composite, would have been down about 10%. You can see the cash was generated a return of a little over 1%. Again, as interest rates have risen, money market yields have increased over 3% right now. The bond portion of the portfolio was down 9%. The benchmark was down 10%. Equity returns are down 3.48%. You can see the global equity benchmark, which is an 80-20. We show that, even though this portfolio is very underweight international, that was down 11.6. Just to highlight, the S&P 500 was down 17.7. So really strong outperformance for what I mentioned earlier of sector weights as well as stock pickings within some of those specific sectors. Next one up, this is the common funds income. Very similar, 57% in stocks, 39% in bonds. And performance very similar. Year to date is down. Year to date, it's down 5.5%. You can see your bonds were down 9.7. Benchmark was down 10. Equities are down 3.5, outperforming all the S&P 500 as well as the global benchmarks. School district, you want to handle that one?
Sure. So school district, split between cash and fixed income here as well. Total market value is $1.1 million. Looking at performance on the year-to-date basis, down 35 basis points for this portfolio. Cash is up 56 basis points versus the benchmark at 83. And for fixed income, down 1.49% versus the benchmark at 4.6%. And this one also has a shorter duration compared to the other portfolios.
I was gonna say, that one still has, we 50-50, close to it, cash versus,
Yes, we typically try to keep around 500,000 in cash, I believe, unless you don't need additional cash, which we can deploy into 3-month or 6-month if you don't think that things are
I'd put a
Going to
couple
be
hundred
upfront.
thousand more into
Sure.
3-month.
3-month.
I think there's no problem doing that.
For the most part, the school district has enough cash flow that if they ask us for money, they're happy to wait 3 months.
Okay.
And it would always be less than 3, so.
Would you want me to bring down the total cash level to 250,000? Would that be a comfortable number?
Between 250 and 300, depending upon what you find to purchase.
Sure.
A lot of 3-month stuff is 4% right now.
You are.
Yeah, pretty good.
And scholarships, again, this account here, the stock weighting is 68%, bonds are 23%. Return's gonna be a little bit different here, especially on the bond side where we're using more of a bond mutual fund just because of the size of the portfolio to create diversification. That's down a little bit more than what was achieved in the principal and income fund. Equities are down 2.8%. So overall, again, equity performance has been really strong and bond performance also has been strong for the portfolios. And the last one up is Quimby. This has a policy limit not to exceed 50%, which we have written into the portfolio. Equities are 46%, bonds are 49%, and cash is about $1,700, a little over 4%. And performance, you can see basically in line with what we saw for the mutual fund allocation for the scholarship. In equities, this is using just more of a mutual fund that was down 6.24% versus the benchmark. You can see down. S&P was down 17%. So overall, protecting these portfolios on the downside. And that's all of our prepared remarks.
It's probably nothing that totally applies to what we're here for, but do you have any comments on crypto?
Looks like Tom Brady's going to get sued. Other than that, we don't invest in crypto for our, across our account base. It's been a very volatile market. You look at Bitcoin where it was, 24 months ago to where it is today. We really don't have a firm view. It's still, I wouldn't say it's in its infancy, but it seems like there's a lot of exchanges that are going through some severe financial pressures. And wouldn't be surprised if you see additionals have some sort of collapse going forward. So we've done a review of it and have walked away that this is an area for our client base that we're not going to invest in or make a broad-based investment into crypto. It's too volatile. And, you could be caught at the whims of, in the case of FTX, some outright fraud, right? Where employees, money was taken in to buy employees' homes. So, they're not regulated. So we typically invest in regulated companies that produce earnings and have a sustainable cash flow. So that's just not an area that we would ever invest in.
I mean, and I know enough to be dangerous, and I don't understand it. I'm kind of like Warren Buffett and Charlie Munger. Don't even understand it and think it's, nothing to invest in. But
Yeah.
I do read that the blockchain has a lot of merits, and how that blockchain would be utilized, maybe just to transfer traditional currency and that sort of thing.
Yeah.
Is that something the bank talks about?
We're looking into that, yes. That's more of your traditional type of money movement versus some sort of crypto exchange that is not regulated or backed by a lot. So, yeah.
I don't have any further questions.
Nor do I. Pat, anything from you, Tom?
Thank you. Thank you
Thank
for
you.
the
Thank
donuts.
you.
Have a good weekend.
You too.
Don't run off yet. There's some other stuff that may pop up here a little bit.
Okay.
I do want to say, as of December 1st, next week, we will have a 10-year anniversary of working with you folks. We appreciate that very much. It's all gone pretty smoothly, markets notwithstanding. And just
And we appreciate the business. Thank you.
tell Susan we said hi.
Just for our viewers, are there I know there's other towns in New Hampshire that you represent, but have you been adding additional towns?
Have we been adding additional towns? Yes.
Any of those you could just mention in passing?
I don't think I can at this point.
Okay.
Okay. This pertains to you folks just a little bit. I passed out earlier and you passed out a more complete form of the MS9. And if you want to turn to I think it's the third page where we have sorry, is it fourth page? Okay, excuse me, fourth page. The Watkins Prize Speaking Prize Spelling Contests. Lisa and I have been back and forth on a lot of these accounts just to kind of bring them into better understanding. And in 1945, Harry Watkins started the spelling and speaking contests, equal donations. And someplace along the line, the speaking contest principal got a little bit more money in it than the other one. We don't know exactly how. Lisa and I went back to 2015 or 17 when Cambridge Trust took over these accounts, and there was a small error there, but over the last 6 or 7 years, it has compounded. So I just wanted you to know, we're gonna journal that into an equity position, so they're both the same, and the next couple of columns over, the percentage allocation should be equal for those two accounts. When you get to the income side, they're different anyway, because we haven't run the speaking contest for a while. And if anybody has any thoughts in that direction, this is a good time to mention it. Otherwise, it's just a matter of correcting some sort of prior error.
Well, actually, that's one of the things I mentioned at one of the prior meetings, is the fact that I can't find any paperwork in the files downstairs of actually establishing these accounts, where they came from, how they started, the fact that they should be equal. But there's nothing to document that in our files. I'm still going through hoping to find something somewhere.
Okay, I'll take a look and see what I have online. Yeah, we don't necessarily have a lot of paperwork from 1945.
Which is a problem, because, you know, you're saying that they should be equal, and yet we've got nothing to indicate what we got and that they should be equal that's actually documented.
Okay.
They're darn close to equal now.
Yeah.
It's just, you know,
It's like $250.
you could have had like something earned a little more or whatever, for whatever reason, or you didn't have a withdrawal. I think that's what you're saying.
Well, we don't
Isn't it?
withdraw principal.
Right.
Yeah, so I don't know. But I don't think it's like a
It's not a big deal. We're just
big
trying
deal.
It's something that we can make it equal
Right.
and then go from there.
Speaking of the speaking contest and the spelling contest, I have had email conversations with, can't remember the first name, Kerrigan, from who's a principal at the middle school, encouraging them to reinstate or rerun these contests. They didn't do them for a couple of years when we were going through the pandemic. And I think it had kind of slipped under their radar. He says, we will try and find somebody to run these. It's easy to run the spelling contest because they kind of do that anyway, but speaking takes a little bit more individual time. And I think it's important that since we have that with a mandate to run the contest from the donor, that we should do that. Of course, it's not up to us to run it, but anyway, we've had that conversation with the school, and
Okay.
that takes care of that. The other item here, I had an email from the library trustees, or from the treasurer, requesting $3,000 from the Patterson Lawrence Carroll Fund. So I need a motion to approve that disbursement.
I move that we release $3,000 from the Patterson Lawrence Carroll Fund, the Merrimack Public Library.
Second.
All in favor signify by saying aye.
Aye.
3-0-0.
Have you given that request to Tom, so we've got it in the files?
I haven't until we approved it. It's now in the minutes.
Thank you.
And we also are receiving, and I think I forwarded them to you, copies of the Merrimack High School Scholarship Review Forms.
Mm-hmm.
As long as we have known heirs, or living trustees or something for those events, the school is sending those forms to those donors, heirs, what have you, just, so those are the ones that are saying to the school, this is how much the award is gonna be, even though we sometimes make a recommendation. The school is relying on those people rather than us. And we will have scholarship award requests coming in sometime in December, early January. So we traditionally have a motion at this meeting authorizing payment of those so the people and the schools don't have to wait and send us out renewal notices or reminder notices and so forth. So if we want to have a motion to that effect, I would appreciate it.
So moved.
Before I second, I thought scholarships were usually awarded at graduation or talked about or presented at graduation. Are these continuing scholarships? I guess I misunderstood.
Scholarships are announced in May or June at the graduation.
Mm-hmm.
They are second semester scholarships. So you get the award in May, but it's not effective until you complete the first semester and have grades demonstrating you did that, and then
Okay,
it's awarded in January.
now they're
for the-
being paid-
For the
okay.
second semester, yes.
thank you.
So these are 2022 awards, even though they're paid in 23.
Okay, thank you. I'll second that motion then.
Thank you. All in favor?
Aye.
Aye.
Okay. And the other stuff we can discuss in a minute, but if you have nothing else, there's no reason to hold you here. You know those things are coming up in the, I think the
Yes.
scholarship fund probably has more cash than it needs, because it's always coming up, and we know the exact amounts that are coming up a year ahead of time. So we could probably cut back on a little bit of that cash. Well, I can't read the fine print here, but how much cash do we have in the income side?
Oh, in scholarships, there's 26,000 in the income.
Yeah, that's not on, that's not principal.
Really? I'm looking at the income section. Oh, okay.
You have it, Bill? I can't read this fine print.
That's the one that it's the one we're all looking at. This one. Yeah, it says 26,968 in the income ending balance.
But that's not all in cash.
Right. So how much do you want in cash? That's a good question.
Yeah, so its market value is $6,655 within the income portfolio.
Oh. And
All
what
right,
is Bob?
so we're gonna give out 3,900. And the other 5,000, usually we get a new check every December from Barbara Watson to cover those 5,000. So that's about an $8,500.
We do have, there's a USD bill that is maturing on December 1st for 13,000. So that will be available, in 2 or 3 weeks.
Okay,
Sounds
so,
like we have too
so
much.
we're gonna be cash heavy at year end.
Yep.
So when we get into January, you may wanna just consider that a little bit.
It's 3,900 that you'll need to pay out in January.
Well, it's actually 8,900,
80.
but,
But you're getting in 5,000.
right.
3,900 is what you need to look at for now, because if we
Right.
get the 5,000 from the donor.
Well, it's almost like the 13 that the sharing promise get rolled back out.
Yeah.
It sounds like you could roll that into like something like a 6-month or 9-month.
So you pay half of it in May or June, so we could have it maturing beginning of May or beginning of June? Would that make sense?
Everything pretty much goes out in January.
Right, so,
Oh, in January.
so it doesn't get paid in May. That's what my confusion was. That's what I,
But the net
So-
balance could be invested couldn't it be invested 9 months?
Yeah,
I was gonna say, could that 13 be made 15 if you're concerned about having too much?
Depending on what you see as the best opportunity. Between 6 months and 6 to 9 months, I guess.
Okay.
Thanks again for coming.
Thank you.
Yeah,
Okay.
have a nice Thanksgiving.
have a good day. Thank you for the donuts. Happy anniversary.
There's no party, but happy anniversary.
Well, somebody's gonna eat the donuts.
That's true.
Okay, so yesterday we had the New Hampshire Municipal Association event, annual convention, whatever they call it. Did anybody go? Did you go, Pat?
No, I was actually committed to at another conference yesterday.
Okay. I didn't go. I didn't have any transportation yesterday. Bill didn't go because of the same thing. But overall, my thought process was that there's only one, maybe two presentations that would be of interest to us.
Yeah.
I don't know if you went to either of those, Tom.
I did. Yeah.
Oh, good.
Which one did you go to, or both?
I went to both.
Good for you.
Yeah, the first one was kind of the general overview. It was, you know, it was nice to meet kind of the new regime in the charitable trusts division. So Diane Quinlan was there and made the main presentation, and she had her deputy there, I guess, and their financial analyst person. So they seem to be on top of things. I mean, that was one concern I had, was the big knowledge drop off from losing Terry Knowles, who'd been there forever. But
Terry left like 3 years ago. Tom,
well, she left, but she was still kind of
Yeah.
yeah,
there on a consultant
A weekly
basis. But I think
Yeah.
now she's all the way out, and then Donovan moved on. So, but I was impressed by their kind of handle on things. But there was nothing earth shattering that came out of that presentation. It was not very well attended, not like it's been in the past. So I don't know what the reason
Well-
may have been for that, but
when the charitable trust unit used to run it, it was
it was a separate.
a separate day-long event.
Yeah.
And the financial advisors were invited as well as trustees, and it was a much bigger, longer, more intense
Yeah.
kind of thing. And then they ran a separate event for experienced people,
Mhm.
second day, if you will.
And I was hoping that they were going to have that particular, the two, because those are the only two that I saw that I was interested in as well. But they weren't virtual. So to go up for an hour of this and an hour of that,
Yeah.
plus I had another commitment. I was actually moderating a Zoom training yesterday for a
Oh,
different
well,
group.
they
So
did
I
have it
wasn't-
on not Zoom, Hoover.
Yeah, but not those.
Oh, I thought they did.
Not all of them. Only some of them were available
Yeah.
virtual. And that was, I would have loved to have gotten it as virtual so that I could have gone a different time because I was committed to something else. But those weren't virtual.
Yeah.
So they picked and chose. Not everything was virtual.
Well, they may not have had the technical
Yeah.
assets to do it on every meeting.
Right.
Because there were so many to choose from. So,
Yeah, so it seemed like compared to what I've been to in the past, it was not as much to get out of it as it was when it was that separate event where it was very well attended, and there was a lot of opportunity for Q&A and that sort of thing. That was I think much more beneficial as it pertains particularly to the trustee of trust funds. The second session was on the changes in the electronic reporting that's scheduled to be implemented next year. That was
Right.
kind of interesting. It sounds like the MS-10 is basically going to be done away with, and they're just going to have you upload your
Bank statement.
bank statements. So that should simplify matters a little bit. You know, we have an awful lot of pages to our bank statements. I don't know how unwieldy it might be for people to access and look at, but we'll cross that bridge when we get there, I
And
guess.
so they just left. Because I know you've been talking to them about the MS-10 and the MS-9 and the changes on that. And the only
I think they're very involved with the company that is coordinating all that, so I'm sure they're aware, and
Yeah, they
maybe they
did,
have.
this time around, they asked the financial advisors, Cambridge Trust and
Yeah.
whoever else is doing that business. So they did get some input.
Mhm.
My hang up with it is that in the old manual days, you had a spreadsheet, all the stuff on what I think of as a more traditional accounting process of lower of cost or market. And now they've kind of interspersed market value here, market value there. And it's more confusing to me to say, well, okay, I can't spend that money, or can I spend that money, or can I reinvest it? Well, you know, it's as soon as you sell it, maybe the market's different tomorrow. And in order to implement that, they keep adding columns. And so it's almost impossible now to put something like that on a spreadsheet. You look at the one that Judy handed out to us today, and it's maybe a 9-point font.
Right.
Yeah.
And
Right.
If you add one more column, it's gonna have to be a 6-point font. So, and when you look at their basic format, it comes out as like 200 pages. So,
that was what I was gonna ask is, what do you do for an annual report? Do we get to create and every town will be different, or are they, because we need
Yes.
to do an annual report, and it would be nice if they were all system standardized.
Yeah, I think it's still gonna be up to the town to summarize in the way they best see fit, so I doubt.
yeah, I've summarized over the last years, cutting out columns. You know, there's some columns that just have no relevance to us.
Yeah.
And I think we'll condense it some more so it can be in the annual report in a 1-page.
Yeah.
I looked at annual reports for other towns, and trustees from other towns often just say, here, we have this total amount of money under control, and if you want to know what it's all about, go to the website.
I really think that's what most townspeople would want, a brief summary. And
Yeah.
if they want to dig deeper, they have the ability to dig deeper.
Most towns don't actually know what it is this board does. And I was gonna ask today, because when you come right down to it, there isn't a whole lot that we actually do because we have Cambridge Trust.
And almost everybody now is using
Exactly.
some sort of financial advisor. We went for several years without. When Larry Hodkinson retired, we stayed with Ameriprise for a while, and they did our trading for us for minimal cost, $5 a trade or something like that. And we didn't do a lot of trading, but we did some, and we did very well. But you can't do a good job with these amounts of money long-term in a couple of hours a month. So Cambridge Trust is doing a great job for us as far as I'm concerned, and having them do all of the online reports and interaction with the state and so forth is a huge bonus.
Yeah.
And their fees are reasonable.
Yes.
So,
I mean, it's important to communicate with them timing issues, and maybe if we see something that they're doing that we think may not be exactly what we like, to tell them that. I mean, that's kind of what we've been doing over the last several years. It's just tweaking things and giving them little hints of our own direction that might be unique to the town, or, you know, again, timing type of things.
Well, other towns are catching up, but I think we were the first town that really started doing equity investments 20, 25 years ago. Most, well, number one, we have more money, but partially we have more money than most towns because we invest it very well. But other towns, and if, and the bequests stimulate this, we're just invested in banks. I know we have one, or had one, I think one of the library funds, and initially said funds to be deposited in the Amoskeag Savings Bank. Okay, where are they now?
They're
Oh,
bankrupt.
that was one of the wills. That's gotta be the pattern, the original old wills.
Yeah.
Yeah.
I have a 10:30
Okay,
thing that I need to do.
okay.
But I'm good with January 6th.
Yeah.
At this point, in February 17th, I don't know. I'm tentative on that, but probably okay.
January 6th, okay?
Yes.
Yeah, we talked
Yeah.
about that last month.
Yep, I just want to be
because
sure.
Somebody wasn't gonna be here. The 17th, let me just check one thing. I apologize. I have a number of family members that are dealing with medical situations, and they know I'm in a meeting, but they're gonna,
Hope everything works out positive.
me too. That's all I do is put my car in automatic and go to a hospital.
That's too bad.
Yeah. I think the 17th will probably be okay. I just wanted, yes, because deliberative filing period, that's the only concern I have. So let me just check on that.
Oh, I have one other quick announcement. Liz had the baby, 8
Excellent.
pounds, 6 ounces, I think. She said to tell you it took 45 minutes.
That's fine.
Wow.
Very good.
So that's where she is this week, is taking care of a very young baby and moving the household to a new house as well.
Well, that's the part that's just,
Motion to adjourn?
Second? And,
okay. The 17th, yeah, we should be okay on February 17th. So second,
all in favor?
Aye.
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 Still out on the lake, Tom, or you?